So, you probably woke up this week, looked at the markets, and just saw a sea of red. The reason? A weekend that saw a massive, rapid escalation in the Middle East. What we're going to do today is trace the shockwaves, that ripple effect from that one single spark, to see just how deep it goes and how it's shaking the entire global economy. And this quote from a market analyst, man, it just nails the feeling right now. There's this sense in the air that this isn't just some temporary flare-up. Right now, the single biggest thing driving every decision out there is just raw, unfiltered uncertainty. All right, section one, the spark. To really get why the markets reacted the way they did, we've got to look at what exactly lit the fuse over the weekend, turning what was a simmering tension into a full-blown crisis for investors. It all happened so fast, you know? On Friday, boom, a direct attack on an airbase wounds U.S. personnel, which is always a serious line to cross. By Saturday, the whole thing got way bigger, as Houthi rebels jumped in, launching their own attacks and just widening the whole conflict zone. And then came Sunday. Reports confirmed 3,500 more U.S. troops were heading to the region. That was the signal to the markets. This wasn't a skirmish anymore. This was a major military confrontation. Okay, so that spark, it created the first ripple. And the first place it hit was right in the commodity markets. I mean, think about it. When a conflict blows up in the world's most critical energy hallway, the price of stuff doesn't just go up, it explodes. The reaction was just violent. And just look at the sheer speed of this move. Brent crude, which is the benchmark for global oil, just skyrocketed 60% in a single month. Now, that's not a price increase. That's a systemic shock, and it's one that's going to echo through every single part of the world's economy. And hey, this isn't just an oil story. The shockwave is also slamming into industrial metals. We saw direct attacks on aluminum facilities in a region that supplies 9% of the world's total, and prices just spiked. So what this means is that markets are now pricing in a double whammy: a transit risk for energy moving through the sea lanes, and a direct production risk for metals that are absolutely essential for manufacturing. So this leads us to the second ripple. And honestly, this one's a lot more subtle, but it's also way more dangerous. It's about a fundamental shift in how the smart money is looking at all this. The market's biggest fear is literally changing right in front of us. Now, your textbook reaction to soaring prices for oil and metal is to worry about inflation, right? But is that what the big investors are really freaking out about right now? Well, it's getting a little more complicated. See, at first, the fear was what we call an inflationary shock. That's where rising costs force central banks to jack up interest rates. But the story's pivoting. Now, the main worry is a growth shock. The fear here is that energy costs get so high, they basically act like a giant tax on the entire global economy, crushing demand and tipping us all into a recession. And that, my friends, is a much, much scarier scenario. All right, section 4, the third ripple. So where do we see the proof? How do we know this new fear is real? Well, for that, you've got to look at the global bond market. What's happening right now with government debt is sending a loud, and I mean loud, signal about a potential recession. And listen, this is not some fringe theory. The absolute titans of the bond world, we're talking PIMCO, JP Morgan, they're all singing the same tune. The conversation has moved on from just inflation. Now it's all about the very real chance of a major economic slowdown. And the big banks are actually putting a number on it. Goldman Sachs has now pegged the odds of a U.S. recession in the next year at 30%. That is a huge risk that, believe me, was not priced into the market just a few weeks ago. So what happens? It's a classic flight to safety. Investors get scared, so they dump their risky stuff and they pile into the safest asset they can find, U.S. government bonds or treasuries. And when demand for those bonds goes way up, their price goes up and their yields, they go down. Those falling yields are a massive barometer of fear, not about inflation, but about recession. Next up, the fourth ripple. Let's zoom out a bit. How is this shock hitting different parts of the world? Well, it's not even. Not at all. This crisis is basically splitting the global economy into two very different camps, creating winners and losers in real time. For countries that have to import their energy, man, this is just brutal. South Korea, a huge manufacturing hub, is talking about restricting driving for the first time in 35 years. Australia is taking the pretty drastic step of slashing its fuel tax in half just to protect people. And Europe, they're getting these dire warnings of a crisis like the 1970s, with a very real threat of diesel shortages. But here's where the story gets really interesting and kind of different from past crises. A lot of emerging markets are actually holding up surprisingly well. See, in the past, a shock like this would cause capital to flee, forcing them to sell off assets. But not this time. Many of them have spent years building up huge fiscal reserves. From the perspective of an emerging market debt manager, these rainy day funds are a total game changer, acting as a defensive wall against the chaos. Okay, last section, the response. Because with all this chaos, you can bet that governments, central banks, and corporations are not just sitting on their hands. This crisis is forcing them to adapt, and fast. Central bankers have long memories. They remember past mistakes, and they're haunted by them. This quote from ECB President Lagarde is basically saying, nope, not again. They are determined to avoid being caught flat-footed, trying to balance these twin threats of inflation and recession. This is also hitting the accelerator on a huge strategic shift. The G7 nations are now making this urgent push to get away from their dependence on volatile fossil fuels. And the strategy is pretty clear. A massive ramp-up in renewables and, this is key, a renewed push for nuclear power to make sure their energy supply is secure. And this pressure cooker isn't just for governments. In the corporate world, a crisis like this forces a ruthless drive for efficiency. Companies have to innovate just to survive. And get this, just look at HSBC. They've rolled out generative AI tools to 170,000 of their employees. This isn't some small pilot program. This is a massive, crisis-driven adoption of new tech to make the whole organization more productive. And the results? They're real. The bank says it's now 10 times faster at supercritical tasks, like finding and fixing software bugs. In a world that's constantly stressed, this is how you build the resilience you need to get through the turmoil. So let's just wrap up with this one big idea. We've traced all these ripples, right? From commodities to bonds to policy. But maybe, just maybe, the biggest, most lasting ripple of all is the acceleration this crisis is causing, a kind of forced evolution pushing us faster than ever towards a whole new world of energy and technology.